In the sprawling landscape of early 2000s telecommunications, where fiber optic cables promised to carry the dreams of the digital age across continents, Qwest Communications stood as a towering giant built on foundations that were far more fragile than investors could have imagined. This Denver-based telecommunications company, born from the ambitious vision of connecting America through an advanced fiber optic network, would ultimately become synonymous with one of the most sophisticated accounting frauds in corporate history. Between 1999 and 2002, Qwest orchestrated a massive deception that inflated revenues by over $3 billion, transforming what should have been routine business transactions into elaborate financial fiction that fooled Wall Street analysts, investors, and regulators for years. The mastermind behind this telecommunications empire was Joseph Naccio, a former AT&T executive who joined Qwest as CEO in 1997 with grand plans to transform the regional phone company into a national powerhouse. Naccio inherited a company that had spent $14 billion building a 25,000-mile fiber optic network stretching from coast to coast. But he faced an impossible challenge: Wall Street's relentless demand for quarterly growth in an industry where legitimate revenue growth was becoming increasingly difficult to achieve. Under Naccio's leadership, Qwest's stock price had soared from $8 per share in 1997 to over $60 by early 2000, making him a Wall Street darling and earning him compensation packages worth tens of millions of dollars annually. But maintaining this meteoric rise required increasingly creative methods to meet analyst expectations, and Naccio was willing to cross ethical and legal boundaries that would ultimately destroy the company he had worked so hard to build. The weapon of choice in Qwest's accounting manipulation was something called fiber optic swaps, transactions that appeared legitimate on the surface but were actually carefully orchestrated schemes to create phantom revenues. These swaps involved Qwest selling portions of its fiber optic network capacity to other telecommunications companies, while simultaneously purchasing similar capacity from those same companies in separate transactions. On paper, these deals looked like normal business activities where companies were optimizing their network assets and expanding their service capabilities. In reality, Qwest was engineering these transactions with one primary purpose: to book immediate revenue from the sales while deferring the recognition of the corresponding purchase costs, creating an artificial boost to quarterly earnings that had no basis in genuine business performance. The mechanics of these fiber swaps revealed a level of financial engineering that bordered on artistic in its complexity and audacious in its scope. Qwest would identify another telecommunications company willing to participate in reciprocal transactions, often companies facing their own pressure to meet quarterly revenue targets. The two companies would negotiate simultaneous deals where Qwest might sell $100 million worth of fiber capacity to Company A while purchasing $80 million worth of capacity from the same company. Qwest would immediately recognize the $100 million as revenue in the current quarter, while treating the $80 million purchase as a capital expenditure that could be depreciated over many years. This created an immediate $20 million boost to quarterly revenue with minimal impact on current expenses, allowing Qwest to meet Wall Street expectations, while the actual economic substance of the transactions was neutral or even negative for the company's long-term financial health. These swap transactions grew increasingly elaborate as Qwest executives realized they could manipulate not just the timing of revenue recognition, but also the apparent value of the deals themselves. The company began engaging in what prosecutors would later call round-trip transactions, where Qwest would sell capacity to Company A, which would then sell similar capacity to Company B, which would ultimately sell capacity back to Qwest at inflated prices. These circular arrangements allowed Qwest to claim higher revenues from each step in the chain, while obscuring the fact that they were essentially paying premium prices for the same capacity they had originally owned. In some cases, Qwest arranged for up to 6 different companies to participate in these chains, with each transaction marked up to create the appearance of legitimate market-driven pricing, while the entire sequence was choreographed to maximize Qwest's reported revenues. The human cost of this elaborate deception extended far beyond the corporate boardroom, as Qwest's fraudulent accounting practices ultimately stole billions of dollars from investors who believed they were purchasing shares in a legitimately profitable telecommunications company. Robin Saliga, Qwest's chief financial officer, played a crucial role in designing and implementing these accounting schemes, working closely with the company's finance team to structure transactions that would pass superficial scrutiny from auditors while delivering the revenue boosts demanded by Wall Street. Saliga and her team developed increasingly sophisticated methods for timing these swaps to coincide with quarter-end reporting periods, often scrambling to arrange last-minute deals worth hundreds of millions of dollars to ensure that Qwest would meet or exceed analyst expectations for quarterly revenue growth. The fraud reached its most brazen heights during 2001 and early 2002, when Qwest was struggling to maintain growth in an increasingly competitive telecommunications market ravaged by overcapacity and declining prices. During this period, the company arranged fiber swaps worth over $1 billion in a single year, with some individual transactions valued at more than $200 million. These deals often involved companies that were themselves facing financial difficulties, creating a circular system where troubled telecommunications companies were propping up each other's apparent performance through increasingly complex and ultimately unsustainable financial arrangements. Qwest's internal emails and documents, later revealed during federal investigations, showed executives openly discussing the need to find gap fillers to meet quarterly targets, and celebrating their success in managing earnings through these artificial transactions. The sophistication of Qwest's fraud extended beyond simple revenue manipulation to include elaborate schemes for managing expenses and creating the appearance of operational efficiency improvements that justified the company's premium stock valuation. The company engaged in what prosecutors called bill and hold arrangements, where Qwest would invoice customers for equipment and services that had not yet been delivered, allowing them to recognize revenue immediately while deferring the associated costs until future quarters. Additionally, Qwest manipulated its reserve accounts and pension obligations, releasing previously established reserves back into current earnings to create additional revenue boosts when fiber swaps alone were insufficient to meet targets. These practices were coordinated across multiple divisions of the company, with executives in sales, finance, and operations working together to identify opportunities for earnings manipulation that would escape detection by external auditors. The unraveling of Qwest's massive fraud began in 2002, when telecommunications industry analysts started questioning the company's ability to maintain revenue growth rates that seemed inconsistent with broader market conditions and the performance of competitors. Short sellers and investigative journalists began examining Qwest's financial statements more carefully, noting unusual patterns in the company's revenue recognition and the prevalence of transactions with other telecommunications companies that seemed to serve no clear operational purpose. The Securities and Exchange Commission launched a formal investigation into Qwest's accounting practices in June 2002, focusing initially on the company's revenue recognition policies, but quickly expanding to encompass the entire web of fiber swaps and related transactions that had propped up the company's financial performance for years. As federal investigators dug deeper into Qwest's operations, they uncovered a conspiracy that reached the highest levels of corporate leadership and involved systematic violations of securities laws, wire fraud, and insider trading. Joseph Nacchio was ultimately convicted on 19 counts of insider trading for selling $42 million worth of Qwest stock, while knowing that the company's financial results were artificially inflated and unsustainable. The evidence showed that Nacchio had received internal reports warning him about the company's deteriorating operational performance and the increasing reliance on accounting gimmicks to meet Wall Street expectations, yet he continued to sell his personal stock holdings while publicly promoting the company's prospects to investors. Robin Saliga pleaded guilty to a single count of insider trading and agreed to cooperate with federal prosecutors, providing crucial testimony about the internal decision-making processes that led to the massive accounting fraud. The final accounting of Qwest's fraud revealed the staggering scope of the deception and its devastating impact on investors, employees, and the broader telecommunications industry. Federal prosecutors determined that Qwest had overstated revenues by more than $3 billion between 1999 and 2002, with the vast majority of this inflation coming from the fiber swap transactions and related accounting manipulations. The company was forced to restate 4 years of financial results, revealing that instead of the steady growth that had driven its stock price to record highs, Qwest had actually experienced declining operational performance throughout the period when executives were celebrating their apparent success. More than 15 current and former Qwest executives were eventually convicted of federal crimes related to the fraud, receiving prison sentences ranging from 18 months to 6 years, with Nacho receiving the longest sentence of 70 months in federal prison. The Qwest scandal ultimately cost investors an estimated $36 billion in market value losses and forced the company into a humiliating merger with CenturyLink in 2011, ending its existence as an independent telecommunications provider. The fraud also led to significant reforms in how telecommunications companies account for network capacity transactions, with regulators implementing new rules requiring more detailed disclosure of reciprocal arrangements and prohibiting certain types of round-trip transactions that serve no legitimate business purpose. Perhaps most importantly, the Qwest case demonstrated how sophisticated financial engineering could be used to create the illusion of growth and profitability in mature industries where genuine expansion was becoming increasingly difficult, providing a cautionary tale about the dangers of prioritizing short-term stock performance over long-term business sustainability. The fiber optic networks that Qwest spent billions of dollars building remain a valuable part of America's telecommunications infrastructure today, but the company's legacy will forever be defined by the phantom revenues that transformed legitimate business assets into instruments of one of the largest corporate frauds in American history.